UTI AMC, India's oldest fund house, has indeed rediscovered itself as various point of time in its long 53-year-long journey in the Indian financial markets. Once again, UTI AMC is at a cusp in this fiscal, touching a new point in its journey, and all indications of UTI AMC launching its IPO very soon. How soon do we see UTI AMC filing its DRHP? What is going to be the future roadmap? To discuss all that and much more in detail, we have with us the Managing Director of UTI AMC, Mr. Leo Puri. Mr. Puri, as always, pleasure having you on ET Now, sir.
Thank you.
If I could ask you, as I was mentioning in my opening remarks, FY18, everyone is keeping a close watch, would be the year when finally we could see UTI AMC getting listed?
Well, obviously all the stars have to align. So as of now, as you say, the primary markets are very active. We've seen 10,000 crores or so being raised, and that number could be 6 or 7 times before we know where we stop. So that's good news. Second, our stakeholders broadly are getting aligned behind this because they see an opportunity for monetization. And thirdly, our markets and business is performing well. So in that sense, I'm optimistic that all stars are aligning. A well-performing business in a rising market, stakeholder alignment, and indeed primary market essentially being welcoming. Surely this is the best time for us to be readying ourselves.
If I could just push my luck, how close are we seeing you filing your DRHP? Any time frame that you would like to put?
From the company's perspective, we are fairly ready. Our board also has indicated that it would like to support this proposal and has formally passed resolution supporting the proposal. That has essentially been put to all our shareholders. The majority of them have also indicated that they are in support. So this is what you would say is a last mile issue now of getting all our major shareholders, all 5 of them, to essentially reach a common platform, common consensus on exactly how to structure the offering. But all other preparations, I think, are more or less in place. So as soon as that is done, I don't think it will take us more than 5 or 6 months to actually hit the markets. So I really am optimistic that it will happen this fiscal.
That's a big indication that you're going 5 to 6 months, perhaps Q4 we could see in everything goes as per the timetable or plan, the listing happening. So if I could just touch upon, you have 4 PSUs, LIC and 3 PSU banks holding close to 8.23%. And then 18.23%, and of course a T. Rowe Price holding the rest. T. Rowe Price has made it public some time back saying that they would like to increase the stake as and when the opportunity arises. So how are you looking at it? Do we see that happening during the IPO or pre-IPO UTI T. Rowe Price has indicated to increase their price? How are you looking at it?
I'm not aware that T. Rowe Price have taken such a stand. In fact, currently, our understanding is that all shareholders have indicated that they will, in varying degrees, be happy to consider participating in the offering. So at this point, the future of UTI will be that of an independent, board-managed, widely held Indian asset management company. And that's part of the uniqueness of the solution. If you look at the industry structure today, I have publicly stated that that is an unhealthy structure, and in fact not a structure which is found in developed markets anywhere in the world. At some point, the regulator also has to look at how ownership and governance is exercised in investment institutions, as they have done in banks and insurers, and they have imposed restrictions on quality and fit and proper and shareholding concentration. The same will happen here. So UTI is ahead of the curve in emerging as a professionally run, board-managed, widely held institution which will play an independent role, as we have done for the last 55 years, hopefully for the next 55 and longer, in developing India's capital markets. So it's a great opportunity and one that should not be missed. And I'm sure the markets will welcome the development.
Mr. Puri, if I could ask you this, I'm asking particularly because SEBI is also on record saying that there are certain conflict of interest, although your shareholders, for legacy reasons, they came and they are holding the shares at this point of time in UTI AMC. Any indications, or it too early? Would there be a full exit or would be a partial exit to begin with? Any broader contours that have been drawn, particularly from the 4 PSU shareholders that you have?
This solution will evolve. The principle is clear, as you say, that there is an existing conflict of interest and it must be resolved. Of course, our shareholders were brought in and have played a very useful role in supporting the institution, and they deserve to be rewarded for that. And given where markets are and the institution's performance, they will be generously rewarded for the support, the welcome support they provided. It's not at this point clear what the specific guidelines are. RBI has clear guidelines, as does IRDA, on shareholding permitted by individual shareholders in the respective entities. So RBI says 5% without permission, up to 10% if you take permission. So if you were to say up to 10% is the maximum you can hold as a financial investor, then that will give you some indication on the kind of dilution needed to remove any overhang of conflict of interest. The only additional point I'd make here is that the banks really need capital at this point, and they are not in the business of financial investors. It is no value to a bank to be holding a passive minority stake in an entity such as ours. They did it because they were requested to do it at that point in time, and as I say, they will today handsomely benefit. Their tier 1 capital will go up materially should they monetize this, which will translate into an improvement in their core business and their stock price. So it would be a win-win for all. LIC, of course, is in the business of being a financial investor, so could potentially continue to be a financial investor in an institution like UTI, as it is in SBI or Corporation Bank or ICICI or L&T and many other board-governed companies. So you have investors with a different profile who will no doubt essentially reach their own conclusion as to what is right. But we want to be widely held. We want a broad-based listing because we fundamentally think that that is a structure which will give us the best governance and the cleanest, most transparent ownership structure and help us meet our objective of long-term development of capital markets here.
Mr. Puri, unlocking the value, as you are rightly pointing out, what better option for PSU banks than UTI? I know your bankers will be doing the back of envelope calculations when it comes to valuation, so on and so forth. But I'm asking you this particularly because perhaps this would be the first AMC to get listed. So in that sense, it would be also a first time when a valuation is looked at from an AMC or how it's valued. UTI with almost 50,000 crore plus of your AUMs, how do you see the valuation spanning out, particularly because this will be the first time that markets will also experience an AMC being valued? So what are the broader indications or contours that you are looking at when it comes to valuation?
This is something for the media analysts such as yourself, Vijay, and others to work out. I'm clearly not going to give you an indication because I'm the CEO. My job is to run the company and do so in a way that will maximize that. But you have to look at other indicators. We have total AUM today in excess of 3,30,000 crores, of which about 1.5 lakh crores is domestic AUM. We have pension funds, we have offshore funds, we also have some alternative assets. All of these will have to be looked at in terms of some of the parts. We also made a healthy profit of around 320, 325 crores last year. We certainly think 20-25% enhancement on that this year is very visible. So typically asset managers are valued on a combination of price earnings multiples, which to me would be a logical way of looking at it. In India, of course, people have tended to look at percentage of assets under management, and there are comparables in the market. I mean, Nippon, Reliance, others have all done transactions, and I'll leave it to the market and analysts. But certainly the indications are that we will be well received. This will be a highly valued opportunity for investors, and even retail investors would be keen to participate in our offering.
Mr. Puri, that's very interesting, testing the resilience of the portfolio. I'm asking you specifically this, what is the instructions that you have given your fund managers? Because is that you would be on a pause mode clearly because the way markets have behaved, where are the stocks available, limited opportunities, or is this also a good time perhaps to churn and rebalance your portfolio? What is the kind of strategy that your fund managers would be putting at this point of time?
No. First of all, just to be clear, no instructions are given to fund managers. That's a misunderstanding of the investment process. As a manager of public funds, Fundamentally, our job is first to make sure we have a very robust investment process based on ongoing research, which we are confident clearly that we do have. The second is to support a variety of styles. At any given point in the market, you will have some managers who are still favoring growth and others who are favoring value. You have some sectors at this point where you have very good companies who are already trading at fairly healthy high multiples, but which are on a high growth path, and there are managers who will continue to have conviction around those. This could be in consumer goods, it could be consumer finance, to take examples. On the other hand, you may have other managers who are value oriented, who at the same time in the same market may take a view that what you're really looking at are companies which are essentially value oriented, where multiples are lower relative to either their historical median or current market trends. But they have conviction that the positioning of the company is good, and they will tend to buy those companies. And perhaps you might see some such companies today in the pharma space or the cyclical space. So you will have managers with different styles free to form their own view. And this is not to evade your question, but simply to underline that in these markets, obviously you can't have a cookie cutter approach or a single approach. So our job, which is true of any fund manager such as us, is to make sure that we make available to investors that range of strategies very transparently. So those investors who have the risk appetite and the asset allocation mentality to say, in this market we want to take more risk around growth and keep betting on growth, they know what product and what strategy they can buy. Those who are more defensive and more cautious, they also should know clearly which funds to buy. But that call is not made by us. If you give me your money to manage, my job is to find the best possible way to deploy it in the market, not to hoard it as cash. If you want a cash, you are free to keep your own cash. Buy a bond fund or leave it in a fixed deposit, that's your call. But by taking a decision to give me money, you are essentially saying, I am still optimistic about equities. Find me the best place in the current market to put this. So that's the mindset with which we have to run an investment process. We don't have the luxury to say,
let's sit back and
I'm just going to hold a lot of cash, because if that was what the investor wanted us to do, he could have done that anyway. He's giving me the instruction, if you like. It's not I who give the instruction. It's the investor gives us an instruction, which is take my money, deploy it for me in the best possible way under strategy X or Y or Z. And that's what we must constantly do and we are trying to do that clearly every day, day in, day out, as best as we can.
Mr. Puri, interestingly, if I could ask you this at a point when we clearly know SIP inflows are here to stay, particularly looking at that trend, clearly a lot of right things have been done. How challenging it's going to be also, and would this be the turning point perhaps in the next 2 to 3 years where we see the Indian domestic money taking a partial weightage, which always used to be the FPIs or FIIs, and perhaps clearly that is also a huge opportunity that fund houses have going forward?
Yes, no, I think it's been a very welcome development that there has been some initial rebalancing in our domestic market towards domestic fund flows. At the same time, we can't overstate this. I would be clear and say that our market is still fundamentally a market driven by
FPI.
Foreign institutional flows, and we can't pretend otherwise. They still control more than a quarter of the free float, and a lot market direction at this point in time is clearly determined by FII flows, even though, of course, I'm very happy that we are seeing domestic institutions play an increasing role. I don't think that pattern will change in a hurry. I also don't think it's necessarily a bad thing in and of itself. It depends on the type of investors. You obviously want more long-only investors, less short-term investors and so on, but that's up to our companies to find ways. This is not something you do as a country. Ultimately, this is an aggregation of individual companies, their strategies, their attractiveness, the investor class they attract, and that's how you build a healthy market, bottom up, not top down. So I'm confident that our market is developing on sound principles there, and that's going to be quite healthy. we're also seeing long-term domestic pension money come into the market. Again, if I extrapolate that trend over a decade, I think that will be the most material differentiator relative to where we are today. I think we are seeing some courage coming into the EPFO board and trustees. Of course, we're seeing the NPS growing, private provident funds and so on are following that path. So the pension revolution and the willingness to diversify into equities is a very, very important step in solidifying the foundation of markets as well.
You have seen many cyclicals in the markets. Where do you see this current trend? Clearly a correction round the corner, and the kind of inflows that we are witnessing, perhaps from a short to mid-term perspective, this inflows will continue, because also the fact remains, where is the growth other than Asia or particularly India in Asia? So clearly the inflows will continue for a while.
Yeah, no, it's of course very dangerous to extrapolate trends. But as you say, currently one of the major drivers of this trend, uptrend, has been liquidity. Liquidity, of course, on its own takes you only so far. So it would be a dangerous situation if we continued on this trajectory purely based on liquidity without any corresponding improvement in fundamentals. As of now, the improvement in fundamentals is a lagging factor. So one has to therefore be somewhat cautious without being pessimistic. The expectation is that you are actually going to see earnings growth somewhere in the region of around 22 to 24% this year, which would be a material uptick from anything that we have seen in the last 3 years. So there is at this point a high degree of faith that investors are placing in the underlying earnings performance of the market, which has of course had the capacity to disappoint. Were it to disappoint, I'm not sure liquidity alone could compensate for that. And liquidity flows both ways. What comes in could just as quickly go out. So I am not somebody who would like to build optimism or extrapolate a trend merely based on the existence and assumption of continued existence of liquidity. That would be extraordinarily foolish and dangerous. Ultimately, we of course are therefore trying to look hard at fundamentals, even if we can't ignore the day-to-day impact of liquidity on our business. But the fundamentals at this point suggest a fairly valued market, indeed in many sectors a fully valued market, not yet a bubble, but absolutely one where you have to start differentiating quite closely areas of conviction where you believe earnings will indeed keep pace, monitor and track indicators that suggest those earnings expectations are going to be realized or disappoint you. And really it's a continuous job to try and filter that information and that analysis out, but that's ultimately what we are paid to do, and that's what we are focusing on. But we certainly are not extrapolating a trend at this point, and markets are cyclical, they are not linear. We must recognize that.
Keep our fingers crossed. Mr. Puri, last couple of questions because we could wind up this interaction. So coming back to corporate governance, which is being debated at all levels for various reasons. SEBI also, as we all know, recently constituted a committee under Uday Kotak to relook at the whole of corporate governance structures when it comes to listed companies. How do you see, from a fund house perspective, corporate governance? Clearly, perhaps fund houses getting more active when it comes to issues of corporate governance in listed companies or the companies which they invest, and the recent example being of Shriram and IDFC, where a merger has been announced. There have been talks, discussions that perhaps it was not done in the right way, the board is not yet cleared it, so on and so forth. But the larger macro issue of corporate governance, how do you see and where do you see it heading? And secondly, do you clearly see fund houses needs to be more proactive in taking stance when it comes to issues of corporate governance?
There's always room for improvement, but just if you look at how far we've come, under some guidance from SEBI, our industry now essentially votes on most resolutions. If you look back a few years, you would have seen maybe 12 to 15% of votes being cast and 85% abstentions. Today that number has clearly reversed. I know speaking for UTI, on more than 95% of resolutions, we actually now cast a yes or no vote. And we have indeed in some cases cast votes which have caused us difficulties in our core business, where managements have not necessarily taken kindly to our opposing their stand. I won't go into specifics there, but it demonstrates that we are willing to actually act on behalf of our investors. See, from our point of view, something like a stewardship code, we would like to see a stewardship code adopted by all institutional investors. In simple terms, that means we recognize that we have a duty as a fiduciary to our investors to engage with companies, to monitor them, and to essentially interact and vote on issues that concern our investors. That's an obligation, fiduciary obligation we have. The principles on which we exercise that obligation should be clear, and as far as possible should be common across all classes of investors, not just UTI as an institution, but all mutual funds, not just mutual funds, but also insurance companies, not just private insurance companies, but also the Life Insurance Corporation, which is a major investor, and ultimately, of course, FPIs and foreign investors too, who participate in this market. All of us ultimately are shaping the way in which corporates perceive the role of investors. And when you think about corporate governance, at least my view is, it's at its heart, it's about how are you going to create value in a disciplined, accountable, responsible way for shareholders. Let's not overcomplicate this issue. It's not policing, auditing, throwing people in jail. I wouldn't want to comment too much on individual cases. Unfortunately, from time to time, and it would be natural, these principles will get tested because there will always be a temptation to do things a little differently, and as institutional investors we get tested as to how we will respond.
Initial thoughts on this IDFC, Sriram, first look at it?
You know, a personal view and not a house view is that I think it is the strategic rationale appears to be that IDFC essentially gets access to an IDFC bank get access to a retail franchise, and Shriram essentially get access to a more sound foundation on a bank platform and an ability to essentially get lower cost funding and presumably better governance and regulation. And on both sides, it could improve the opportunity for exit for investors. On balance, it looks somewhat like the value creation will accrue to Shriram holders somewhat more than IDFC shareholders, but you know, the market has to wait to see how the swap ratios and so on will work out, so it's a little early to tell. I'm sure given the people involved that they will exercise a high degree of discipline and caution on how they conduct themselves. And I would expect this to be done in full transparency with support and respect for minority investors involved in the deal. So at this point, we just have to wait and watch. It's a very interesting strategic transaction. I hope it gets executed in a way that will carry all stakeholders. Regulators are going to play a very key role in addition to minority investors. But done in the right way, this could actually turn out to be a genuine win-win for all parties concerned. And I hope it will be done in the right way.
My last question, Mr. Puri, GST finally, after all the debate, getting rolled out from July 1st, would that be a game changer and turning point that Indian economy was looking for?
I'm completely in the camp that says this is a tremendous reform. You know, maybe not quite with the freedom at midnight and the symbolism of that, but it is a very, very important reform. Of course, yes, it creates a common market, but beyond that, you're going to see such a steep rise in tax compliance, because essentially it's a self-policing mechanism. All of us now are going to essentially be part of the taxed economy and be responsible citizens. We will, like it or not, become part of that system. It will place a burden on the quality of governance, because these new tax revenues have to be utilized well for development. You'll see a shift from producing states like the Gujarat, Maharashtras of this world to maybe the Madhya Pradesh, Bihars. Not a bad thing in terms of redistribution. But again, then those state governments need to use that for development. So if we do all of this and if we utilize this opportunity with common market, better tax compliance, an opportunity for redistribution, an opportunity for development expenditure to go up, it is hard not to be optimistic, despite the obvious glitches on implementation, the inefficiencies, the political compromises on multiple rates. I concede that. But none of that takes away from the fact that this is a very important, much delayed and highly welcome reform, which will stand us in very good stead.
Puri, once again, thanks a lot for spending this. Pleasure talking to you.
Thank you very much.
Thanks for watching this special interaction with Mr. Leo Puri, only on ET Now.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.